Hey, welcome back to Everything Money. We're glad you joined us again. Today, we're going to highlight our software and the stock analyzer tool to find how do we determine the fair value of a stock. Paul, this is a pivotal piece of the puzzle that I don't think a lot of our new investors know of. Our patrons, they've got tons of experience in this now. But in essence, if you are buying stocks on a ticker, which I was for many years, Paul, and you were guiding me through the idea that I don't just buy Netflix and hope it goes up. You've taught us in all these videos that we need to look at the fundamentals behind a company. So say we start falling in love with a company. Yeah, maybe it meets all of our 8 pillars. Go ahead, pull one up, Paul, in the software.
So we can use our software, select all 8 pillars, go. So here are all the companies that fit our 8 pillars. Now, one that I bought recently is Intel.
Of course.
Right? So let's look at Intel. Intel is a company I bought recently. I feel like it's been beaten up. Look at this, guys. 20 years ago, it was up here. And now it's at $75 a share, and now it's at $53, 20 years later. But the company's revenue keeps going up. Its profit keeps going up. So I look at this as a beaten down company selling at 11 times earnings. All right?
So this is falling in the wheelhouse of a potential buy for us. But then the question is, Paul, and what you might be watching as a viewer, is $53 a good price? I don't know. It used to be 80. It's lower. Does it have potential? Could it go lower? Where are we going with all this? How does this work, Paul?
So with our software, I don't believe in just buying only stocks that have all 8 check marks. I do not believe in that. But it's a way of telling a story, okay? Now I look at Intel saying, okay, this is a big company, has a big market share. Are they potentially going to be losing market? Absolutely. But from my perspective, I want to look at it and say, is it beaten up because it's selling for 11 times earnings because people just think this thing is dead? Potentially so. What I do is I go into our stock analyzer tool and I start from here. First thing is, I pick years of analysis. I always pick 7. I don't know why I pick 7. It's just always gravitated towards me.
Other channels do this as well. They
pick 7?
Yeah, they do. They pick 7.
Oh,
yeah,
really?
I've seen this.
You can pick 5, you can pick 10, you can pick 20. But the reason I like 7 is I think it's easier to kind of gauge a growth rate over 7 years versus 20 years and having a consistent growth rate. So what it does here is this thing shows you the last 1 year, 5 year, and 10 year annualized on everything above. Revenue growth, share change, profit margin, free cash flow as a percentage of revenue, PE, price to free cash flow, and desired return. So I just go in and say, okay, I'm going to be conservative on Intel. My goal is to be conservative. Let's assume they don't grow at all on the low end. They grow by 2% on the middle range, and they grew by 4% on the high end. Okay? That's a high end growth. I don't know if it's going to happen, but let's just assume that. Share change. Guys, they're buying back shares like crazy. So -2, -3, and -4%. Actually, let's go -2, -2.5, and -3%. Now with share change, you go from higher to lower here because that's the more conservative number. Is a higher share change than a lower one.
Mm-hmm.
A little counterintuitive. I get that, but just trust me on that one.
Okay.
Profit margin, very consistent. I'm going to do 22, 23, 24. Free cash flow as a percentage of revenue, I'm going to do 20, 21, and 22. And the reason being, I think last year's fluke year was probably not to be trusted because of the market and how there was demand for chips. Now, for PE, a company this big and this slow growing, I'm going to keep this as 12, 14, and 16 PE. And the same thing for the free cash flow.
So large, slow growing companies
should have a lower PE and a lower multiple free cash flow. And that's what I'm accounting for here. Then I do a desired return. I always start at 15%, which is very, very high. And I don't ever really look at that one. It's just as a reference point. 15%, 12.5% return, and 10%. I hit analyze, boom. So what's this telling me? It's telling me as long as I believe my middle assumptions here, I am buying it for a price that'll get me a 12.5% return as long as I believe these assumptions. The other thing is I look at the high assumptions going, oh my gosh, if the high ones occur, which I don't think are egregious, this company could be a $100 stock at some point here in the future, right?
Mm-hmm.
I look at it saying, okay, Intel to me is selling for around where it should be for me to be a value player. Because a lot of value guys want a 12 or 13% return on their investments. And I think the middle range is probably where you want your assumptions to end up being kind of where the market's going to go. So I look at it saying, yep, Intel's a buy here. Now, does that mean we're just done there? No, but this gives you an idea of where you should be when buying a stock. If all these numbers were red, it's basically telling me avoid the stock.
Paul, unfortunately, if people actually click on YouTube and type in stock investing advice, they're going to get people that don't look at any of these numbers.
And if that works for you,
they pull up They pull up analyst projections.
Yeah, I don't ever listen to analysts.
They see
I avoid
stock
them
trends
completely.
going in the upward trend. And
That's
then
called recency bias.
And then they title all their videos "Massive Price Prediction." Why don't you ever say
because it doesn't work. That didn't work in 2000. Didn't work for real estate in 2005 and 6. Eventually, with bubbles, it doesn't work. Are we in a bubble? I do believe we're in a bubble. Some people disagree with me, but when I see 18, 19, 20-year-old kids being stock market and crypto experts, that just tells me. The average person in my Facebook is talking about all the investment money they're making, just tells me this is a bubble and this is going to end up bad. What I'm trying to do is teach fundamentals that work over long periods of time. There are a lot of value investors in the crash of 2000 who made money. Forget about didn't lose as much. Stocks fell 40, 50, 60%. They made 30, 40, 50%. Okay. Manesh Prabrai, one of our guys, what did he make in 2000? What was his numbers, Mo?
I don't know off the top of my head, but I know Howard Marks crushed it back then.
Well, he was doing debt. He wasn't doing stocks. But I think Manesh Prabrai was making like 70% a year.
He was in 69, 70% over a multiple year period.
I mean, it's insane because value does work over a long period of time. And all I'm asking you to do is, if it makes sense to you that a company should be worth some sort of multiple of its revenue, profit, and cash flow over long periods of time, which, by the way, any privately held company is, then you sit there and say, let me bring this example. If you had a company that was generating $10 a year in profit, and I was a genie, and I said, let's say it's selling for $100 right now. I were to say to you, 10 years from now, it's going to be making $100 in profit. This is a reasonable multiple. $100 for $10 of profit. That's a PE of 10. Mm-hmm. Would you say the price is going to be lower or higher than $100 when it's making $100 in profit?
It should be higher.
It should be. Now, there are examples out there when it didn't occur. But one of those examples, in 2000 with Intel, Cisco, Amazon, they didn't grow to the same level of their revenue and profit growth. Mm-hmm. Why? Because they were overpriced. My goal is to show you through the stock analyzer tool how you can make assumptions on certain companies that you love, any company you love, and see if it's overpriced or not. And see where you should be. It's not to say buy it at this exact price. It's more of where's the feel for it. Then you do more research and come up with more of your exact numbers you want to do here. None of these assumptions here are crazy. None of these, even the high assumptions aren't crazy. They did 4% a year for the last 10 years themselves. So it's not really unreasonable to say, oh, maybe. Now, if you want to be more conservative, great. Do this. Let's just assume Intel sucks at generating income. Guess what? It's still pretty close. This is only 80 cents lower than our current price. So it's still pretty much all green here. This tells me, okay, Intel's probably a pretty reasonable buy at these levels. Does that mean I'm going to be right? No. But if I have 100 Intels, 100 companies like this, and I buy them in full, if I buy stocks in them, I'm going to do very, very well in the market for the next 7 years. And that's what I'm trying to get at. I'm trying to find 20 to 40 companies that look like this that I can buy for less than this middle range. That's it.
So, Paul, I wanted to bring up this little diagram you put up because this is speaking to me right now. As you said, if a company has $10 in profit and then years later it can go to 100, the price in PE today is 10. That's great. But I think the problem is if you put a 0 behind that price and make it 1,000, this is what you mean by I can't currently overpay for a company, right? Because when it goes to 1,000 in the future,
you can overpay. But if you do that on 30 or 40 companies like this, you will end up hurt. Because the future is so hard to determine. So if you're already paying a huge premium on the future potential, you're going to end up hurt. Because guys, just think about the last 20 years, how many major events we've had that have hurt stocks, that have hurt anything. We've had 9/11. We've had a credit market crash. We've had a housing market. We have all these things happen. And could you have determined that in 2000 we're going to have those major events occur? The biggest recession in history. Not. COVID. Oh my God, we had COVID. Yeah. 20 years ago, between 20 years ago and today, we've had the biggest terrorist attack against our country. We've had a real estate market crash. We've had a credit shutdown, and we've had a worldwide pandemic that shut down the economy and dropped it 34% in one quarter, right? Mm-hmm. These things, and then when things are overpriced, that's what gets affected because all of a sudden those rosy ideas don't occur anymore.
What do people use if they don't have a stock analyzer tool?
What did you use before?
I guess I used common hearsay I found from my friends who probably
like a company, therefore you buy it without knowing anything about the
fundamentals. I guess that was it. I'm asking.
This is a very common thing. By the way, it's so funny to me. People I tell people, would you buy a business this way in private? Well, it's different. It's not different. When you're buying a stock, you're buying a company.
That really resonates with people I talk to as well, because especially if you're talking to a business owner, you say, okay, how about this cupcake shop downtown? Or would you buy that? What would you think about it?
So one of my neighbors in Mexico who has a house next to me in Mexico, he's a big Tesla fanboy, doesn't care about any of the fundamentals. I offered to let him buy a house, and he's like, well, let me see your projections. I'm like, oh, now projections matter. Now fundamentals matter. Got it. So of course I said to him, you're not the right investor for me. By the way, the house is killing it. But the whole point was, I didn't like that hypocrisy. Buying a stock is the same as buying a private business. It's the exact same thing. The exact same thing. When you buy a stock, you're buying a piece of a business. So you have to value it as such.
Yeah, so finding the fair value of a stock is difficult. We urge you to be cautious in watching other people who are happy and inviting, telling you that the fair value is what it is today. For a lot of these overhyped stocks with pre-revenue, no revenue, they literally don't make any product at all, Paul.
Oh, by the way, even if they have revenue and profit, it doesn't matter. If you're paying too much for that revenue and profit, like Tesla, there'll probably be issues. If you have There is. If you have 30 overhyped stocks that don't make money, it'll be a problem. What's the date on this? August 12th, 2021. Let's see how ARK Investments does over the next 3 to 5 years. Let's see how it does.
It's filled with overhyped companies that don't make any money.
The top 20 holdings, 17 don't even make money. Do I think some of those companies will still do well over the next 20 years? Absolutely. But the question is, you go back to 2000 and you pick all the .com and tech companies and you bought them all, you've only doubled your money over 20 years. Doubled. That's it over 20 years. That's a 3% return. And 80% of that gain, of that doubling, was from 3 companies, yes. Microsoft, Apple, and Amazon.
In context, at a 10% return, you should be doubling your money every 7 years.
Yes.
And so,
which means you would have doubled 3 times since 2000, which means you have 8 times your money versus 2 times your money.
Incredible. That is our take. Good luck out there. If you want the software, be a patron. We're moving off Patreon to everythingmoney.com in the very near future. Don't worry, patrons. Your Patreon lineage will go right to our new platform. You will not have a pay raise, or your monthly fees will never go up. And in essence, it'll be a better platform as we do away with Patreon and some of their kookiness that we can't put up with anymore. We're giving away a Tesla this fall when we hit another 100,000 subscribers, which is very exciting, Paul. We'll be giving a Tesla away. And if you're a patron, you're automatically entered. So that's our take. Fondle the thumbs up.
Like us on Instagram. Follow us on Instagram.
Be careful out there. And we'll see you in the next video. Thanks for watching.